Hey, stop scrolling. I need you to understand something that most people are completely missing about silver right now. Before we get into it, my name is John A.G. I don't have a paid group, I don't sell courses, I don't sell anything. This channel has always been and will always be completely free. If anyone ever contacts you claiming to be me and asking for money, that is a scammer. It is 100% fake. Please protect yourself and report it. Now that that's out of the way, let's get into what I actually do here, which is give you the data, raw and unfiltered, for free. Let's go. Today is March 1st, 2026. Silver is sitting around $90 an ounce. The media isn't covering it. Your bank isn't talking about it. And most retail investors have absolutely no idea what is building beneath the surface of this market. In the next 25 minutes, I'm walking you through every layer. Fundamentals, technicals, macro forces, industrial revolution, and where this price could realistically go from here. Whether you've never bought an ounce of silver or you've been stacking for years, this video is for you. Where are we right now? Silver is at roughly $90 per ounce today. 12 months ago, it was $28. That's a 220% move in under 1 year. Before you call this a bubble, hold that thought, because by the end of this video, you'll understand why this might be the beginning, not the end. 3 numbers that define the market right now. Gold to silver ratio, 55-1. Gold is near $5,000. The historical average ratio since 1970 is 55. We're right at the mean. In 2011, it compressed to 32-1. At that ratio today, with gold at $5,000, silver would be $156. That's not a prediction. That's just math. 6 consecutive years of supply deficit. The Silver Institute confirms 2026 is the 6th straight year demand exceeds mine production. The cumulative shortfall since 2021 is over 820 million ounces. Nearly an entire year of global mine supply, gone from inventories. Mine supply capped at 813 million ounces per year. New mines take 7 to 15 years to develop. No production surge is coming. Supply is structurally fixed. Demand is structurally rising. That imbalance doesn't fix itself quietly. The industrial demand. Silver is no longer just a monetary metal. Over half of all silver consumed today goes into industrial use, and that number grows every single year. 3 demand engines driving this. Solar energy consumed over 200 million ounces in 2024, more than 25% of total global supply just for panels. Researchers at the University of New South Wales estimate cumulative solar demand by 2050 could equal 85 to 98% of all known silver reserves. And there is no commercially viable substitute at scale. Electric vehicles use 25 to 50 grams of silver each versus 0.5 grams in a regular car. With 30 million EVs projected to sell in 2026, that's roughly 29 million ounces from one product category that barely existed a decade ago. EV-related silver demand grew 20% in 2025 alone. AI, data centers, and 5G. Every server rack, every connector, every base station uses silver. Microsoft, Amazon, Google, Meta are collectively spending hundreds of billions on data center expansion through 2030. This is a hardware boom that runs on silver. The combination of solar, EVs, AI, and 5G is what analysts are now calling a permanent demand re-rating for silver. The old price models didn't account for this. They're being rewritten in real time. What the banks are saying. JP Morgan projected $81 an ounce average for 2026. We've already blown past it. Their key insight, though, was this. Silver is still pricing off gold momentum, not yet off its own industrial fundamentals. When that switch flips, the repricing will be significant. Bank of America, $135 base case, $309 extreme scenario. The $135 is pure ratio math. Gold at $5,000, ratio at 32-1 equals $156. The $309 assumes a physical delivery squeeze similar to 1980. B of A called it low probability but put it in writing. That matters. Gold Silver's Alan Hibbard, $175 plus dollars target, calling 2026 a value recognition moment, the year the market finally prices in structural deficits that have been ignored for years. The range from serious institutional forecasts, $85 low end, already beaten, to $309 extreme. Median clustering around $100 to $175. The risk-reward asymmetry from current prices is genuinely unusual. Reading the chart. Silver hit an all-time high of $121.88 on January 29, 2026, then crashed 47% to approximately $63.85 in 8 trading days. That terrified people. But it was structurally healthy. Leveraged speculative positions blew out, paper market cleared, physical buyers stepped in around $80. Since then, price has formed a textbook cup pattern. Base at $63 to $64, now testing the neckline near $90 to $92. Key levels to know. $92, the neckline. A weekly close above this on volume equals breakout signal. $100, the psychological level. Only closed above it once in history, January 2026. A sustained hold here brings in institutional money sitting on the sidelines. 121, 122, the all-time high. First major bull target, 35% upside from today. $75, the line in the sand. Daily close below this breaks the cup structure. The COT signal is what makes this especially interesting. Managed money. Hedge funds and commodity trading advisors currently hold only 5,472 net long contracts. During the January spike, they were positioned at multiples of that. The institutional money has left. The recovery from $64 to $90 was driven by short covering and physical buying, not fresh speculation. When those funds re-enter after a $92 breakout confirmation, that's when the next vertical move happens. Federal Reserve rate cuts. The Fed is now in a cutting cycle. Silver is a non-yielding asset. When rates fall, the opportunity cost of holding it disappears. Every major cutting cycle since the 1970s has coincided with a meaningful silver bull market. This cycle could last 18 to 24 months. Dollar weakness. The dollar index fell over 8% in 2025. It's expected to continue declining in 2026 due to U.S. fiscal deficits and global de-dollarization. Every 1% dollar decline mechanically lifts commodities 0.5 to 1%. That's a built-in tailwind. Geopolitical risk premium. Central banks worldwide have bought gold at record levels for 3 straight years, deliberately diversifying away from dollar assets. Silver benefits from the same de-dollarization trend, and its industrial indispensability makes it even more strategically valuable to nations building green energy infrastructure. The tariff wildcard. Section 232 investigations into precious metals imports remain open. Any reimposition of tariffs on silver would create immediate physical tightness in U.S. markets, similar to January's squeeze. Low probability, but massive upside impact if it happens. This is not a one-way street. Here's what could derail the bull case. Hawkish Fed reversal. If inflation re-accelerates and rates go back up, precious metals face a significant headwind. This is the single biggest risk. Dollar strength. A surge in the dollar index above 100 would mechanically pressure silver lower, regardless of fundamentals. Global recession. A severe economic slowdown would reduce industrial silver consumption. This happened in 2008. Silver fell 50%. Context is different today given mandate-driven EV and solar demand, but it's not zero risk. Technology substitution. Research into reducing silver content per solar cell is real. If manufacturers meaningfully cut usage without sacrificing efficiency, it dents the demand growth story. Not a near-term risk, but a 5 to 10-year consideration. Volatility itself. Silver dropped 47% in 8 days in January. If you cannot stomach holding through that kind of move, that's important information. Position sizing and time horizon are everything with this asset. The full outlook. Bear case. $65 to $75 by December 2026, approximately 20% probability. Fed reverses to hikes. Dollar surges. Industrial activity slows. The cup pattern breaks below $75, and we test the 100-day moving average at $69. Macro overrides fundamentals temporarily. Base case. 110 to 140 by December 2026, approximately 55% probability. Fed continues gradual cuts. Dollar softens. Industrial demand grows 5 to 8% annually. Gold to silver ratio compresses toward 40 to 1. Institutional money re-enters on a confirmed $92 breakout. This is the scenario the weight of evidence supports today. Bull case. $160 to 200 plus by December 2026, approximately 25% probability. Physical delivery squeeze hits COMEX. Tariff shock drains U.S. silver inventories. Mainstream FOMO buying triggers. Dollar accelerates lower. This is the scenario that gets written about in financial history books, and it has real, identifiable catalysts. Even the base case alone, 20% to 55% upside from today, is compelling against most other asset classes. The bull case, while unlikely to fully materialize, contains scenarios where being underpositioned is a significant missed opportunity. That is the complete silver picture for March 2026. 6-year structural deficit. Industrial demand revolution from solar, EVs, and AI. Institutional targets from $135 to $309. A technical setup coiling for a breakout, and a macro environment of rate cuts and dollar weakness working as a mechanical tailwind, all simultaneously. I'm not telling you to buy silver. I'm not your financial advisor. What I'm telling you is that the data is speaking loudly, and the people paying attention right now are positioning ahead of everyone who'll hear about this when silver is on CNN at $150. If this brought you value, like the video, subscribe, and drop your silver price target for end of 2026 in the comments. I read every single one. See you in the next one. Key on-screen data points. Current spot, $90. Authiola, $121.88. 12-month gain plus 220%. GSR 55 to 1. 6-year deficit. Mine supply cap 813 million ounces. B of A target $135 to $309. Support $75, $69, $57. Resistance $92, $100, $121.